All right, recording has started. Good morning, ladies and gentlemen. This is Clueless Trading Frank. This is our weekly, very important advanced coaching sessions. It's been a long week, so I'm sure all of us are a bit tired and caught up on a little bit of sleep. Today is August 19th, 2017, approximately 11:14 a.m. Eastern Standard Time. The session will be recorded and uploaded to the YouTube channel, and ACS students only will have access. Full disclosure, this is purely for financial education and not for any solicitation or advice. So what we're going to try to do today is I'm going to show you a whole bunch of things that I'm monitoring. We're going to talk a little bit about what I think from these type of changing market conditions, and the key word is changing market conditions, how we can, what type of trade strategies work, or what would be the most beneficial. Because as market conditions change and the character of the market changes a bit, not that dramatically, but it's changing, you have to basically look, as every trader should, and I've always done that, to see where you will maximize your profits by with minimal utilization of your trading capital. What it simply means is you can randomly go out there and buy stuff and expect to have a big bang for your buck on any type of reflex motions, long or short, that will occur in the markets. You need to be selective. What it really comes down to, what I've always felt and done the best on, is to play the indices. I mentioned that a few times on the Twitter feed, as you know. The SPX, the SPYs, the IWM, RUT, the QQQ, I think are terrific vehicles because the market always moves, right? Up or down. Stocks don't always do that. You know, in a crappy market, you're trying to, let's say we're trying to short like a stock like Goldman, and it doesn't fall, right? That's what happened. I mean, that's we didn't short Goldman. I mean, we did short Goldman, but you can't, but even when the market was down, it was flat to higher. Or selective positions like Ulta Beauty and things like that. So you can randomly go out there, and all patches of the biotech sector, they were not falling and dying on a mass scale. So I think playing the indices is a good utilization of your money because those are going to move for sure. All right, so that's number one. Number two, as we go through a bunch of things that I've already posted, and I'll give you what my thoughts are, and then you guys can certainly discuss what yours is. I believe that we are in a the market character has somewhat changed. There has been, no question about it, a substantial technical damage that has been detected for sure. No question about it. You can see that here. This is, I think, the simplest visual that I can show you. That's the the ES, the E-minis. And when you look at things like that, you cannot just deny the fact that there has been technical damage that has incurred. No question about it. That's the sole reason why on the 16th, which was Wednesday, things are moving real fast here. Wednesday, I went ahead and posed, when I saw that sudden change, not just on this chart, you guys know, the buying size in fixed calls, SPX puts, and those obviously paid off huge that day and the following day. So the fact is that I'm not generally, as you know, running around buying the VIX calls, but I've done it before. UVXY I've done, and they didn't really pay off that well. So I decided to do the VIX calls. They're cheap, and they flew. 40, 60 cents up to $3. Even the 40-cent ones, which were September 19s, So you're talking 19 VIX, right? Those were alerted at around 30 to 40 cents. They went to slightly above $1. So imagine that. You got that much time, and then they're 19s. The VIX is not even close to 19. The VIX is at 14 and change, and spiking to about 15 and change. So like I said, you got to change. You got to keep these things in mind to play the market. The SPX, the index calls and puts, and the VIX calls. I haven't really tried VIX puts. Somebody asked me. I said no. I'd rather stick with my S&P shorts. But those are good vehicles to play. Am I clear on that? Yes.
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 Okay, sounds good. Just wanted to make sure that you guys, we didn't have any audio lapse. All right, now let's take a look at. So the second thing, the third thing is that the speed and the ferocity of the flash crashes and reflex rallies seem to be just going, just going on hyperspeed. That's the word that I used. They're going on hyperspeed. I mean, look at this. This is 1 week. This is just from the 10th. And you got this. We played this very nicely. Things looking like, they're going to go. And then comes the Economic Council resignations, right? And all that other fiasco. And then this. So the bottom line is that we have to really be alert. And that means that sort of like, okay, I'll buy and I'll forget about it type of trading, which a lot of traders do. It's just not going to work if you're looking to make some decent money on these type of volatility moves. Because volatility moves is like driving through a massive snowstorm or a rainstorm or whatever, or a tornado. So if you don't have your hands on the wheel and all your functions and your senses in gear to react to situations, then you're not going to be able to trade this market. So on days, for example, where you cannot watch the screens, or you're just kind of like looking at my stuff, like not because I'm posting real time here, right? So I'm trying to keep people abreast as much as I can on changing conditions. So if you are not able to monitor that closely, then on those days, don't trade. That's the best way to do it. There's nothing wrong with not trading on a certain day. So reaction time has to be quick. And some new traders, they complain, oh well, you said this would happen, you hear that. That's normal. But they're living in some fantasy land. They're not, they want to be traders, but they don't, they don't want to face the reality of what's going on. So you can't do that. What you learn in driving school before you got your license is not what the reality of urban driving is, right? So it's not a straight highway. So I just want you guys to understand that. I know you guys do. So that's it. The fourth thing is there has been a appreciable change in risk appetite. Now, what do I mean by that? There has been a in the sense. This is what I really meant to say. To make some really powerful money on whatever happens going forward, up or down. And we're going to talk about it, and we're going to figure out the probabilities of what will happen, and the scenarios of how much we can go down short term, and everything is short term at this point. Okay, so bottom line is that your risk level has to be higher. In other words, you should be prepared to take a higher risk element when you're trading. Otherwise, you are not going to make any money. People say, well, I don't want to risk it. Well, if you cannot risk a certain amount of capital, which you designate as real risk capital in trading, then you shouldn't be trading, period. There's always risk in options trading. We all know that. Okay? There's always risk in trading and investing. We all know that. But now that risk quotient has gone up big time. In other words, you have to be aggressive. Aggressive on the short side, aggressive on the long side. So the more you focus on my charts, the more you'll know the points which are being pinpointed out where you need to be aggressive. Your time frames have to be time frames can be a swing time frame if we can get some sort of confirmed signals, which we don't fully have yet, mind you. Or you can if you are busy, if you're active during the day, scalp during the day. This move alone was good for me for almost 5 to 6 S&P points on the 2425 and the 2430 calls, which I alerted. That's decent. I bought a bunch of contracts, 5 points. You go figure. You make some real decent money. You buy 4, you make $2,000 each on each of the trades. Not a bad day, right? Just on one trade, because I pinpointed this move, told people to buy, and there was a bunch of great trades on Friday off the reversal trades. So you got to manage your trades. I took a bunch down, positioned myself for Monday. The RUT calls, for example, alerted around 6:30, 6:50. They went to $9.30. Okay, these are the 1365s for next Friday. RUT, not bad. You can get in at 6:50, get in at 7. You could still get 2 points on it. Even getting a point on it. Buy a couple of them, just made yourself money. So is it easy? No, but those levels that I'm showing, especially on all these indices, you can make some real decent money during the day. You don't need to hold anything overnight if you don't want to. You'll miss the gap up or gap down depending on the positional trade that you have, but you won't. You can avoid the sort of surprise risk that comes with holding things overnight. But that's okay because the surprise risk is on both sides, right? Get huge gap open, boom, sell it in the first 5 minutes. You're done with your trading day. Walk away. It's happened many, many times. We know that, especially of extreme conditions. So those are the, the last thing I'll tell you is that we're going to see a huge barrage of announcements, political and economic, coming out next week. We're coming towards the latter part of the month. I want to remind everyone, as you know very well, that the middle of the month, for technical reasons, and there's always a different factor here and there. This time it was obviously amplified because of the political stuff going on. But the middle of the month is always rocky. So if you look at a date count or a day count, the middle of the month basically ended last week because 15, give or take 2 or 3 days. And that's exactly what happened. So now we have crossed that. We are now on the latter stage. We have 8 trading days. I'm sorry, 4. 9 trading days left in August. And that's what we're going to talk about. So that's it. So let's start off by looking at this one. And this is, I'm showing it as a pattern symmetry. It's pretty easy to see what's going on. Active traders can trade these candles, fast candles, all right? Up and down. And you can see that they're intersecting at exactly the trend lines that I have drawn. These trend lines, as you all know, are not drawn after the fact. They're drawn before the fact. So if you trade off these lines, you're making money. You're making decent money. So here is a line that comes from all the way back here, which was, seems like an eternity ago, 27th of July. Okay? That was drawn and I had left it there. And and that is the projected extrapolated line, that one, this one. So, and you notice that the market spiked from a low of right there, the 2420 mark or so on the ES, very, very important number, and spiked hard after well, this was the 17th. The day started here at around 8 o'clock, 9 o'clock. There you go, 10 o'clock, and the market spiked. and hit a high at approximately noontime. Now, it was monthly options expiration. I did say that there's going to be a lot of pinning the strikes and all kinds of stuff that happened. And that's so this spike lasted close to this previous gap fill, and I was pretty much selling right around here. Suddenly, you saw a this was the so-called abandoned quits or fired whatever rally. That's all garbage. It's all technical stuff going on. They're just looking for reasons to the noise to bring it up. Now, this move, a bull will say, hey, that's not a big deal because it was contained within the framework of what's going on here on the pattern. But more importantly, this move came because there's a lot of technical damage done here, right? So you fall off a tree and you completely break your limbs. You're trying to recover, walk a little bit. You are going to stumble a bit, but it doesn't mean that you're falling off the tree again. It can happen, and we're going to talk about that too. So that's what happens. So what is that? So that could be a chunk of margin sellouts, which generally start off at around 2 o'clock. Started off at 1. And then there was another one at 3. And if you notice, the media, CNBC, the financial network, don't really like talking about that stuff. Well, that is a technical reason, you know? And so the sloppiness that occurs in the last 2 hours of the market, especially on a Friday, monthly options expiration, big margin calls still pending, and margin clerks do not want to carry those over the weekend on their books. So they sell your positions out. Simple. All right. So, and that is exactly what happens in the last 2 hours or so. And that's something I've explained over and over again. I worked on Wall Street for many years. I know what margin sellouts are. They take a chunk of your portfolio and then they sell it out, depending on your margin call. Whichever the case, they flatten their books. So there is no risk carried overnight. I'm talking about the institutional desks, the margin desks. Okay. So when you have that kind of damage, which was on the 17th, and they give you, it's T plus 3. So Monday is the last day that you're supposed to come out with the money, but this started actually on 17th. Let's say it started on the 16th, in which case Friday would have been your deadline, right? You know what T plus 3 is? Trade date plus 3. They give you 3 days to come up with your margin requirements. And they give you 2 days extra grace period. So sometimes. So if that's the case, then you got another day or so left of some cleanup. Anyway, let's look at this pattern here. If you just look at a fast glance on this pattern, if it works, then we have, I think max we can move to is roughly about from here, where we closed at 24 to here, the downtrend line. This downtrend line is formidable, 24.65. So you're talking about 40 points, right? You're talking about 40 points. 40 points is a lot. That's 240 points in the market. Can it happen? Well, I don't want to repeat myself. Sure, it can happen. Sure, it can happen. But along the way, we have big hurdles. One is this big fat red line. That's your 2440 level, which was considered by many so-called institutional traders as a number that the market would respect. Well, it tried to respect it, and then it fell through. So that has now become major resistance. Just playing it for 20 points from here to here, for example, right? 25, let's call it, 25 to 40. You got 15 points here. If you're able to be active, you can trade this very nicely, very nicely. From here, we see how things work, right? Because we know how things work because we've gone through these a lot. And the most recent example was this one, which was just first week of August. So what's happening is, if we look at it where we were at 24.88 and we hit 24.19 or 24.20. So we lost close to 70 points, right? We lost close to 70 points, right? From 2490, I'm rounding off the numbers, to 2480, 2420, we lost 70 points. So we lost roughly about 420 points or so on the Dow Jones Industrial Average. Let's look to see if that number is correct. I'm going to look at my other screen. The Dow Jones Industrial Average, let me see here, hit a high of 22,179. 22,179. We closed at 21,674. Wow, that's 505 points. Okay, so we have lost 505 points. Now, this is nothing new to us because we talked about this, right? But along the way, it hasn't been, oh, I'll just short here and wait, and then we're going to get there, right? It doesn't work like that. And a lot of traders, especially newer traders or stubborn traders or whatever, emotional traders, just don't want to, accept it. You cannot just short something at the top and say, okay, I'll just see you guys later in 2 weeks. Sure you can, but in that case, you'll have to blank yourself out. During this period, because you'd be freaking out. I don't need to explain that. That's that's so obvious. Okay, so we have lost 500 points. We have lost 500 points from here to here. 505 points on the Dow. Very simple math, and I've seen this happen over and over again over the years. SPX likes to move in 100-point increments, roughly. Okay, Dow likes to move in 1,000-point increments within very large swings, plus minus 1,000 points. Okay, S&P plus minus 100. So if you look at 22, what was the high here? One second. You guys following me in all this? It's, simple stuff we're covering. We're at 2488. So we should be at 28. So 100 points, if you want to look at it that way, is like around 2388, right? So that's a little bit below here. And we'll look at that scenario. And after that, you get the major moves. However, let's talk about the Dow Jones for a minute here. We lost 500 points. Dow basically is on its way to lose another 500 points, but it doesn't happen in a straight line. So that's what we're talking about here. After a 500-point drop, you are bound to get a reflex rally, which, if the market conditions, and I'll show you guys what I'm noticing, breaks and there is a CIT, change in trend, then it'll fail and it'll go lower. So, but it's happening very quickly. So hypothetically speaking, we lost 500 pounds. We lost 500 points. We're going to kind of bounce back about 200 to 250. Okay, just 50% Fibonacci retracements. That brings us right here. Max move. In between, trade my levels. That's all I can tell you. Patterns are pretty defined here, as in the volatility patterns. And you guys basically have to construct this chart on your side and move on. Now, small stuff which I notice. Watch carefully. We hit a low of 24.23 here. We hit a rock bottom on the stows. These are the fast stows, the 14.13. All right. We hit a lower number here by 24.19, 24.24, right? And look what happened. This should have hit another low. Instead, It created a minor, but still worth noting. This is where the big money's made. The same thing happened here. The same thing happened here. It created a minor positive divergence on the internals. It's more, and I showed that on my charts too. Okay, it's more easy to see on Thinkorswim. So there is some positive divergence going on. Positive divergences on the 1 hour charts play out over a day to 2 days. On the 4 hour charts, they could take takes pretty much the same time, and on the daily, it takes a bunch of days. In other words, if the market does decide to land up here, it's not like it has to do it on Monday morning. But I'm watching this very, very carefully, very, very carefully. Either we create another double bottom, or the market basically comes back a little bit, retests, whatever it does, and it will. And if this keeps on doing the positive divergence, then you're going to have a blast. And that's called a coil spring, right? And that blast is fast, a couple of hours maybe, because that's exactly what's going on. So that's one scenario of this simple chart. The second, this is really a trend line chart. It's a trader's chart. This is not an analysis chart. This is just a trend line chart. You're going to trade off these trends. The second thing is, if you look at the volatility cluster here, this is a bit more amplified, but it's pretty much the same. Here, if you look at this, if you put a 4 hour thing on, you will see that this is a bullish engulfing candle. The last 2 hours, to me, options expiration, margin sellouts, already explained to you. So I'm not giving that much weighting to this last candle. That's my opinion. Whatever the case, if this pattern happens, you know what to do. And there are going to be some quick, sharp sell-offs. These red ones are look all nice and pretty on this chart, but when they happen in intraday, you get upside down on certain trades. This was a reversal from 24.45. Look at the number here to 24.37. That's roughly about 48 to 50 points on the Dow, real fast. 2 o'clock, right? 2 o'clock on the 11th. Freak out time for retail traders, people who don't watch these things or don't care about really understanding, and they freak out and do whatever wrong things that they do. So beyond that, we have to keep watching the ultimate simplest indicator, the stochastics, because through all that, this was moving higher. This was moving higher. All right. Any questions on this particular chart before we leave it? K-Bot?
No.
Good.
No.
It's all clean. This is one of the easiest trading charts that you can use. There is a big fat trend downtrend line here, DT line. There's another one here. There is another one here, which intersects with the gap level. And if we break out over that, the max move is the second one. You got to just literally know these lines inside out and construct them yourself on investing.com. Just go there, just pull up the indicators and just draw them. So this is the 1, 2. Now there's another one here, which is sort of midway. That comes from the highs of the 14th, when we were creating a cup and handle. At that time, it was a cup and handle. Remember that? Look, cup, handle, then a breakout over the handle. That was the handle, the consolidation. So that trend line was drawn during that time as the market broke out of that handle. And that is also a waypoint for traders right there at 24.48. That's it for this chart. Let's look at the big one, which is, I purposely left it like that. This is your daily. There's some big inflection points. One is that this green line here is your big fat breakout line that occurred back in May 25th. We talked about this many times, the multi-month breakout, which was retested. So that's there. That's the 2400 level, 2404 on the minis, right? So just call it the 2400 level. Very important. Very important. This one is your big fat drop on the 17th. This one was the 16th. So 17th is here. This was actually, well, yeah, this was this was Friday. So these lines, I just showing you guys where we can go. I drew a consolidation channel, not a perfect one, but it's there, and you will see that it intersects at around this move here, right there. So use this as a roadmap too. This is an ugly one. This was an ugly one. Slight slippage, and then you see what happens. So if the pattern symmetry works out, this is what happens. So we could slip a little bit more, and then this. Market wants to fail, it's going to fail here hard, and you're back to that zone again. Or scenario 2, we collapse right away on Monday, and we hit the big fat support, and then we attempt to bounce from there. So the few, the calls that are being carried overnight on the markets, S&P, RUT, whatever, you expect the cost average or just sell if you see a breakage of this line. If you cost average, your cost average zone is right there. There will be, without a single doubt in my mind, just standard procedure, either a bounce from here or straight flush down here. Pure fear. That's what we're showing the markets this week. We got TRIN, which I'll show you guys, at 1.3. That's big. In the old days, we used to look at the TRIN all the time. That's the real fear index. That's called the ARMS index. Richard Arms was the one who actually created that. The TRIN, T-R-I-N. The TRIN Q, which is for the NASDAQ, was closed at 1.27, and the TRIN for the New York Stock Exchange closed at 1.12. Those are heightened capitulation type of numbers. And through all that, the VIX remained down. Interesting, huh? It didn't really spike up to a new high. Telling you something. Simple stuff to keep in mind. So this is it. Am I clear with this chart? We are there. We are deep down there. If we are going to slip down more, it's basically going to do this and just kind of stay down here, and then it's going to do this. Am I clear on this one, on this chart?
Yes.
From a trading thing. So once you guys are like I said, simplicity is key. Don't have to overanalyze things. Look for patterns. That's what we do, and it's a very powerful tool. It's a very powerful tool in trading. This is more of a swing type of stuff. You really can't trade. This is the daily, so you can't really trade off this on an intraday basis. You got to revert back to the 1 hour and the 4 hour, or the 15-minute, whatever the case may be. But this gives you an idea of where we are and what can happen. There's a lot of pressure on this one, so I wouldn't be surprised at all if we slip another 100 points real fast. From here to 2400, you're talking about another 150 points or so. 100 to 150 points, right, to fill this move. Now let's move on. So now let's get into some more detailed stuff. So here I constructed a megaphone. I've constructed megaphones a few times, as you guys know. And they've worked. I'm not sure if this is going to work, but I'm just showing you the probability. A megaphone is a megaphone, just what a megaphone pattern. This is a 4-hour chart, the closest cousin to the daily. Major support at these levels. Obviously, you can keep on going down and down, but I'm just kind of going back to, you can go lower and lower, but I'm kind of going back to April. The April lows. So at this point, I just joined the contact points here, and we're pretty much there. Now, these are volatility clusters. You can see that. And I showed that too on my chart. I highlighted the volatility clusters. Lots of buying and selling going on here. A battle between the bulls and the bears. That's where, and the longs and the shorts, that's where the volatility clusters happen. So from a volatility cluster standpoint, we talked about these ranges, which are still visible. 25 points from here, right? 100 to 150 points. But volatility clusters, volume. I'm watching volume very closely on the things. These things help me so much with my trading, and I try to share as much as possible for those who care to during the day. For those who care to be, real tactical traders. It's not easy. Disciplined technical trading is a completely different ball game than this standard price watching trading. You guys know that by now. But it pays me well, so it's okay. I get caught in something, get hurt, I make it back. And this is what I'm watching. We are seeing, this is obviously positive. We don't know whether this is going to cross over because, like I told you, by the time the crossover is fully detected, you remember from the last ACS, right? The market's already up 100 plus points. So this is certainly coming off deep oversold and now crossing over. By the time it's up here, right? Like I said before, and it exactly happened, if you guys remember, right? From, this was huge for me. So this was just what? 11th, just keep on showing the reflex crash and the massive monster bounce. This is big, very big for me. So bottom line is that by the time that the crossover was detected, we were already up a good solid 100 points. By the time traders start to get excited, generally during this hump, it's too late. So you got to, like I said, your risk level based on the trading capital has to go higher at these points because you have to be aggressive attacking these points. That's what the machines are doing. So if you can catch them even 5 minutes earlier, 10 minutes earlier, an hour earlier, you're golden. You catch them 5 hours later or a day late, you're too late. Sorry, see you later. Volume, capitulation volumes, big. Just visual, look at these. Capitulation volume, big. That's in 1 week. In 2 weeks. This is 2 weeks actually, right? 8/10 to 8/18. 10, yeah, going into last week. Right? You see that? Loud and clear. Big short covering. Big. Right there. For the first half of the day. Last half of the day, all kinds of sellouts and all that stuff. Still smaller than what happened the first part of the day. That's your short covering spike. Okay, that's real money going in the market. Even the Najarian brothers who basically track this stuff, like they mentioned, there were some big S&P block buyers that came in. You think they were waiting on the Bannon news? No. Of course, as if anything's going to change because Bannon's not there. Big deal. Yeah, there's some political dynamic on the sort of what do you call a news cycle, but it's not what changes markets. The bigger thing was that Gary Cohen's still there. That's what Wall Street cares about, right? Because without him, a lot of things will go wrong on the economic side. That's all. So, so bottom line is big capitulation volume. We're liking this. So the 4 hour for now, I know what my downside is when I'm going to basically cost average right there at these levels. So that's roughly 6 points from here, roughly 40 points on the down. If this breaks, if 2400 breaks with another candle of this magnitude, that means something is really going wrong. Something is definitely going wrong here because there was big block sellers and stuff, but a lot of it had to do, which I mentioned to you guys on VIX expirations, which I don't fully understand, but read up on it. These VIX expirations are huge, and VIX futures, and there's a contango. which is what Golf also has mentioned and shown through his, you can go to VIX Central. It means that the longer the future months VIX levels are not showing any dramatic spikes. All right, so it's called backwardation, right? That's right. I have a very difficult time saying the word. You guys try to say it. Backwardation. That means the VIX is backed up on future months versus what it is right now. K-Bot, do you understand that term? I mean, do you understand what I just explained?
I think so.
Okay, I think so means you didn't. So let me. All right. So So let me just explain to you. If it, you just mute me so I don't hear my stupid voice. So let's say a asset VIX right now is currently at around 13. So what the forward months are showing, according to the backwardation or contango, that VIX, that they are not looking for the VIX to basically spike up to 20. I don't know how much I really trust this, but I'm just saying they're basically saying the VIX will be here or slightly lower for the next month or two. I don't know how they come up with that, but generally what backwardation means, contango, which is with oil, is whatever the oil prices are right now. Okay, let's say oil right now is at 48. I can't remember the exact number. Then future months, the futures are showing that oil is going to be around 46. So even though it's spiking now, in future months, the futures are indicating that it is going to be slightly lower. Do you understand that part? So what the VIX backwardation is showing, that wherever the VIX is at the current range, I don't think they look at a certain price, at a current range, okay, which is basically between 13, between 14 and 17. That's really what the VIX is right now. That in the following month or two, it is not going to be 25. It is going to be more in the 15. Let's say, instead of 13 to 17, maybe it's going to be between 11 and 15. You got it?
Got it.
Okay. Now, what does all this mean? It simply means that they are not expecting risk parity models are not expecting any massive fallout within the next month or so or two. You got it? That's the reason why VIX is not showing an elevated level going out. Understood?
Yes, sir.
Okay, that's good. That's good. So that's what it is. Don't worry about that stuff too much, to be honest with you, because I don't know how much it's correct or not correct. We just have to go by what we see. So so let's take a look at so we studied the all the stuff on this one, right? Good. Now let's move on. Now, from a standpoint of candle studies, this was certainly not good. The last half hour. I mean, not half hour. The last half of the day, right? Look at this. However, it did not affect the underlying. Again, that's what positive divergence is all about. It didn't affect the underlying movement or crossover of the 4-hour full stochastics. This, because it could have easily kind of taken another slide down. So that's a mild positive. Mild. I use the word mild. Let's take a look at this. Is a bigger picture of what's going on. We've already seen that, right? Megaphone pattern. This is the bottom of the megaphone, which is roughly about 40 to 50 points lower. Major support. So we're good with that. We studied this right now. Let's take a look at okay. A bigger picture of the S&P. Let me just bring this out. Actually, I'll go one screen at a time, not this split screen, so it's easier for everyone. I'm just going to put this as SPX. Stop me with any quick questions as I move along. So this is a 4-hour chart, and we have this line needs to be adjusted. I'll do that in a second. We are seeing a major positive divergence on the S&P, number, more so than the E-minis. This reached the full stochastic reached 7, right? Right there, 6.3, right there. When the S&P was at 2442, that's 17 points higher. That's 105 points higher. We reached rock bottom. We went lower. We went way lower from 2443 all the way down to 2420. That's 23 points. 110 Dow points lower from here to here. That's why this line, right? What happened with the internals? The internals made a higher low. That's a positive divergence. That's the reason why it's there. Nothing more needs to be said. That's because I got to go by, as a technician, I got to go by what I'm seeing in front of me. Gap. Remember that pesky gap? Well, got filled nicely, and then moved up fast, and then this happened, right? Last half of the day, for reasons we just covered. Let's draw a couple of lines here. Give or take. This is actual S&P 500. We just discussed the E-minis on that on previously. So I literally watch every single line. So where the inflection points, where what happened, and then you start to see it. It's just it's like submarine warfare. You got to watch the periscope and see what's out there. Have any of you ever peeked through a periscope? You've been to? Have you ever been in a submarine, like like the real kind, but just visited one? No?
Yeah, I did. It's pretty
Yeah.
cool.
Yeah, I know. Me too. Very, very cool. So this is basically underwater warfare going on here. All right, the battle of making money through tactical trading. So every line matters to me. Every line matters. So look at this. These are all inflection points. This one was, and by the way, these arrows are not generated. These are generated directly by Thinkorswim. These are not mine. So here you have a turn point. That's exactly where the markets went. Right there. Okay. Here's another one. Big inflection. All of a sudden, bang, hammer reversal. That's right here, 2412. This one is the retest of the 2420 Monday morning, or futures prior to Monday, Sunday night, would be perfect. Then you got this one, 2412, and then this is a big one because that was the breakout line retest, and we talked about it. Let me change the color. Let me put it in glaring blue. There you go. This is basically no man's land, because if you break fast, we are going to go, and Jessica and me talked about this a while ago, and I've explained this, we are going to fall real fast to the bottom of this trading range, which is 2352. So no questions asked. If we break this, then the chances of a sharp of any type of reflex bounce out the window. Am I clear on that? Yeah? Okay. Very easy to see. Right there. 50 points, 60 points. I think you can swing this short. You can swing this baby. Boom. Because this level here becomes range trading. So 60 points, you're talking 360 to 400, 400 Dow points. Nice short trade, right? And nowadays it's going to happen real quick. But here's the question. When was the last time that we saw markets just basically just continue straight down? Doesn't happen like that. So these bounces from these levels are what's going to happen first. And the market is going to try to bounce and recapture, at least on the 4 hour, or the 50, which is a cross down. That's a negative. or retest, try to hit the beloved 20-day moving average. All right, we're going to look at this on the daily too. So the bottom line is, what pattern does that create? K-bot? A bounce from here and a failure at these levels here. This is another major inflection point. What pattern does it create? K-bot?
Yeah, I'm here, but I can't tell.
Okay, you can tell? All right, let me just explain to you. This creates a big fat head and shoulder, bearish. Okay, look. See that? There. Remember, a head and shoulder looks like this, with a neckline, which is the 2400 level. Once you break that, you go lower. You got it now? There's your head. Here's your rounded top. And I think this is what's going on. This is your rounded top. Here's the left shoulder, which is approximately at that 20-day moving average, which is around 2456 or so on the 4-hour chart. And that creates the right shoulder. You have the left shoulder, you have the right shoulder. You have the neckline, which breaks, you get down towards the lower end of the band. Do you get it now?
Yes.
Jasco? Jasco probably saw that anyway. Jody?
Yes.
Okay, so that's clear to you guys, right? So we are,
Yes.
yep. So the chances of a total, another like huge thing, a red candle, is it possible? Sure it is, because the markets have been, anything can happen. A shock to the system, like whatever. You are still looking at a major support level here, period, where there will be a bounce. Just for shorts to cover. That means the reflex, that cat bounce. But it's straight from here all the way down to here, well, just won't happen. Not in one day. Will markets like to basically do patterns before they happen? They try to fool people. So when that cat bounce happens, don't get all excited. That is simply to make money on and then short the market, depending on how it's reacting to these lines. Currently, the yellow line, which has been our one of our best trading indicators, is what? Is your 5-day moving average, right? The 5 SMA. Well, the 5 SMA, if it's going to do that dragon bullish, is going to do this like this. Right? Right there. It happened. This was the gap open, which is a possibility that I showed on Monday morning. Remember, the president and his staff are meeting this weekend in Camp David, and there's some heavy duty stuff going on. I don't think they want to see the market fall apart. That's one of the key milestones of the Trump presidency. He mentions it all the time, right? So I don't want to see. He doesn't want his critics to say, "Oh yeah, great, you're talking all this stuff, and look at the market." So there is a Trump protection team, just the way there's a plunge protection team. That's why Wall Street needs to, Gary Cohn, these guys are very, very important. That's the way business works. So they'll come in to protect the plunge. And the Fed is next week, I believe. Some statements coming out of the Fed speakers and stuff. I'll check in that. So it's busy. So there you are. Let's add one more thing here to this drawing, which I haven't looked in for a while. I bet you it's showing a cyclical pullback on the market. Let's look at the daily here. Let's move all these lines. And we talked about this, if you remember, where we are at what points. So on the daily S&P 500, we are currently heading towards this is pretty dramatic, you can see, towards the 150-day moving average. This breaks, that's it. That's a major change in trend. Here, there is still hope for the bulls to recapture and try to get back above the 50-day moving average, which is approximately around 2450. There's going to be a lot of power in the form of a breadth thrust. Remember that? Those are the big fat 300-day 300 point type of moves, which creates a big fat candle and then carries the market higher. Happened, during the elections. Happened in the second week here. You can see that. These are the big fat candle. I'm trying to identify more of those, not just the small ones, but you can see there was one. Not really. These are the ones which are called breadth thrust, which basically break away from the gravitational pull of a downward market. Multiple candles can be looked on as a breadth thrust, right? So at this point, this would be the 2400 level, the 2389, like we said. That's key. That would basically mean a 100-point S&P likes to move in 100 points, 100 points on the S&P. That would be the really, really powerful bounce point, because even a bounce from here to here would generate significant profits, even if it fails at that point. That's why you got to trade charts at this point. Forget about what we think and what's going on, this and that. There's the gap. If you remember that gap right there. And I said in last ACS, this gap is going to get filled. And this is how the market does it, right? Moves up sharp and then just kind of fools everybody and then brings it down. So at this point, we already talked about it. We got this, a little bit more here. These are oversold in order to market not to collapse towards the 2400 level. And at that point, believe me, no one's going to buy anything. And that'll be the best time to buy for a fast trade. Remember, everything is it's getting faster and faster. But the silence that we see in the chat rooms, the silence that we see outside, the non-committal traders kind of sitting back and saying, oh my God, we're still making some decent money on a bunch of trades. And I'm showing you what this cleanest way you can make money on, both on the short side and the long side. That's where we're focusing on the indices, period. Don't have to look around too much. Don't have to worry about whether Tesla's jumping 20. K-Bot's asking me about Priceline, which turned around very nicely too. But the chart on Priceline looks like crap for now. So I don't talk about Priceline because my job is to look for areas of alerts where you can maximize your money. Buying a couple of lottos on Bank of America, you immediately, within the first 10 minutes, were up 25%. Why not use money in those type of trades instead of trying to buy an expensive, it's still very expensive, Priceline call, because I like to buy close to the money. Yes, the stock might move $20, $30, but then how much money do you really make if you don't, if you don't buy it closer to the money? So again, you have to look to see where you can maximize your money. Alibaba stock, bad market, good market, the funds are buying the crap out of it, and the shorts are getting toasted. Good stock to trade on a market reflex to 172 to 175. I've been talking about it from $90, $100, 120, 140. Alta, good stock to play for a reflex bounce. So best to use money in these type of things. So look, Priceline, I've traded so many times. I'll post it again, but don't focus on that as much. Just K-Bot, do you understand what I'm saying?
Yes.
Look to maximize your capital in these high risk markets by using the smallest amount of money for the largest amount of returns. That's my philosophy during extreme conditions. These are extreme conditions. So don't go around, Tesla calls, easy to trade. $2-3 moves up 4-5, boom, take it off. Priceline, you got to pay an arm and a leg if you are looking for a little level of safety by buying closer to the money. Anyway, you know what I'm saying. So this one, that's it. This is your head and shoulder, K-Bot, like that. There. The bounce will fail at the 50. That will confirm that there is a major change in trend. Because so far on the daily, ladies and gentlemen, like I always say, keep it simple, the KISS principle. We still don't see any big deterioration of the 34 and the 50 moving down. Jasco, Jody, you see that?
Mm-hmm.
Yes.
They're still moving higher. Markets are showing the ugliest candles, you know, and all stuff. But the moving averages, aside from the sharper, aside from the 5-day, which is like so the faster moving traders line, right? Which is this one, the yellow one, that moves up and down real fast. You can see that. That's fine. But the big daddy, the big kahunas, is still kind of, meandering up. The 20 has has shown this curvature during times of pullbacks, during these 500-point type of drops. Of course it is. But it's still not showing a plunge. And I know Jasco uses the 20 a lot and reminded me to add that to my charts, and I do appreciate that. It helps a lot. Even during this type of plunge, and this is a similar type of plunge, by the way. This was back in going back to March, right? The 20 moving average is still trajectory is still higher. When you see this plunge, the 20 plunge like that, that means we are going to basically fall straight towards this level. So looking at the moving averages, guys, we are, we're not seeing any big technical deterioration. I start noticing that I am going to short every single rally if I start to see a crossover down, which almost happened here. Almost. Right? That was back in April. Almost happened. But if it's a significant crossover down like this, and K-Bot, you listen to it because you're new, and so is Jody. You see a movement down like that, crossover down, and my eyes are trained to watch for angles and steepness of curves, crossovers up and down. But the steeper this crossover down is, that means there's big money coming out of the market. That's some sort of big financial crisis type of thing, major political crisis, things like that. What we're seeing right now is not a big political crisis. It's just the shifting patterns, what we call political game theory. All right. So that's it. So that's your first indicator. You don't need me. You'll just have to look at that and say, oh boy. Or when the 20 crosses below, the 50, slices below the 50 and the 34, like it did here. That is when you start saying, oh boy, something's really going wrong. Okay, what's the other thing I want to show you guys? Because these are real important for our trading coming into this week. Very important. So this is the 533 chart that I've shown. Bear with me 1 second. And this is the way you read it. This is very important. You are in oversold zone. So that's a plus for bottom fishers. That's very nice. I like this. This is going all the way back to March. This is heavily oversold. -6 on the MACD. That's saying something. -6. All right. Last it happened was back on March, and we had a powerful rally that ensued of this level for a bunch of days. Like I said, it's just a bunch of days type of thing. S1, support 1. S1, we are right there. That's 2420. Pivot is at, and this is more of a swing chart, so don't try to use this for daily trading. What happened here? Funny stuff. Hold on. Bear with me. Let me try to retrieve this. And this helps me a lot. This, okay, looks like I got it back. I have to reconstruct it back, so I'll just do it with you guys. So what I do is I go back a few months. I want to see the reference points. Every technician should always do that when they're looking at charts. price labels. Here's my Bollinger. Where is it? Bollinger Man. We are good to go. Now we have a real picture. Everyone see this clearly? So, like I was showing you. Now I have the mark here. So here's your 2376 is S2 generated by this particular chart. Pivot is at 24.55, exactly at where I think the market will probably go up to, maybe overshoot a little bit to the mid Bollinger 24.65 and then fail. That's what I think. So, and these are showing exactly the same things. See, to me, each of these numbers, which to you guys too, is a lot of money when you're doing SPX trading. It's a lot of money. You don't need to, troll Tesla and try to buy. Why the heck is that not going up? Because stocks move with news too, right? So indexes, they are clean up and down. That's why futures traders and stuff, a lot of them really good ones, they don't even look at stocks. They just trade futures because it's the cleanest way of trading. So there you go. And then you have R1 at 2,500. Interesting, huh? The first resistance comes in at 2,500, and that's your upper Bollinger. Now, here's another interesting thing to notice, that the Bollinger shape of the curvature of the upper Bollinger still has not changed despite this technical damage done here. And the lower Bollinger is at 2435, which we are below right now. Very, very critical. Stocks, markets, very seldom stay below. Stay below or above their Bollinger Bands for more than 1 or 2 days. Am I clear on that? In other words, this Bollinger, the market will bounce back into the lower Bollinger, and that's going to happen, and that's your reflex bounce. Just want to be very clear about that. Stocks do that too. So when I see a Bollinger overshoot, and I mentioned that on my comment, try to understand what I'm saying. You shoot way out of a Bollinger Band like a magnet. You're going to basically slice it back up into it. The same thing on the upside. All right, let's keep these things in mind. So here, this is the simplest way I'm reading this. Nice deep oversold. We like stochastics. Just the way here looked like they were all crashing. Here's your positive divergence. K-Bot, tell me where you see the positive divergence here. Look at these candles, which are the price levels, and look at this, which is the stochastics. What do you see? Look at this price. Look at this. Okay, where the prices are. And then look at this. Where do you see the positive divergence?
The other one is closer to the 2340. It's going higher.
Correct. So in other words, you got it. It's real visual. So basically, you made a higher low on the stochastics, which are very important. All right, while prices went lower. You got it? So right there is your positive divergence. Will it play out? I believe high probability yes. What's that high probability yes? Is that bounce that we're talking about. Got it? So that's it. This deep oversold, generally speaking, of these oversold levels, these are really deep oversold. You get a tactical bounce. So this confirms my thesis based on what I've been talking about this coming week, going towards the end of the month. We'll talk about September when September comes, before September, obviously. Let's take a look at the NIMO. This will basically be interesting because I didn't get a chance to see it on Friday. So I'm seeing it for the first time. Let me construct this with you guys. This is extremely important to trading. Bollinger, okay, we got that. Okay, good. We have price labels. We don't look at candlesticks on NIMOs. We look at areas, and then we look at a color that I always use. And bingo, we have a picture of what is going to happen. Are we ready? The New York Stock Exchange McClellan Oscillator is big for my trading. Why is it big? Because it's done very well for me. We have a NIMO, despite all the sharp drop in the market, which has been edging higher. The same positive divergence is in play. The NIMO went to minus 82. I said it's a hands-on screaming buy. I was dead right. We bounced hard the next day, the following Monday. Remember? Right? So, bottom line is, now we created a lower low on the market, yet we only went down to minus 59. Guys, these are not just numbers. These are real deal money-making signals. Look what happened back in March. We went to minus 88, hands-on buy time. Jumped up, pulled back a bit. Look what happened. Jumped up, pulled back a bit. Very similar pattern symmetry. This was deep oversold when we went to minus 82. And now we are basically still edging higher, and the RSI, Relative Strength Index, is at 50. Remember, once the Relative Strength Index crosses over 70, I don't care how excited I am with your prices and like, oh my God, you think like, oh, you're a genius because you bought in at the right time and you bought the lows and this and that. You sell. You see RSI shooting up like this, yes, it'll drag on for a day or two. But all of a sudden, from nowhere, when you're sitting pretty and you haven't taken your taken your unrealized profits or pared down, which I always say, take down large profits. Okay, bang, this happens. Everything that you're up, gone. So once it crosses over the 70 mark and stuff, yes, it's a sign of strength. But given the volatility in the markets, you're deep, you're heavy overbought at those levels, and within a day or two, after the market decides to lull traders into a feeling of safety, because most of the time they're buying all the way up here anyway. I try, some people just never learn. Guess what? That's when they drop it. So, looking at the NIMO, these are the biggest things that, the McClellan Oscillator. This is the most powerful chart. This is good. This is good. We made a lower low in the markets on the S&P 500. We made a lower low on the S&P 500. We made a higher high on the McClellan Oscillator. Now, is it possible that this can just go like this and create a double bottom? Sure it has. I mean, sure it can. But I haven't seen that happen, just so you know. Now, all through all this stuff, the MACD is moving higher. Isn't that interesting? Just the way it kept on moving higher here. Now, MACD, once it goes positive, can have a minor top, minor couple of bars. But generally, when it comes off this, it creates a equal and opposite symmetry bar. So if the deeper you're coming out of, now, markets were lower in March, so we're all the way up there now. But if it does that, and that's the very bullish sort of forecast, and creates a move like this, equal to that we were down minus 7. So let's say it gets up to 7, okay? And everyone's like, oh, this bull market will never die. All that kind of stuff, stuff that you keep on hearing, is basically where the market hits that upper end of the Bollinger of 25.15. And the megaphone, if you look at my megaphone, the upper end of the megaphone is in that 2500 plus level. Got it? It's very accurate, these things. So that will only happen if we see a burst out into positive MACD and a move higher. I'm not even go that far. I think there are certain things that have changed underneath the market, but I don't know. I do also know that $1.7 billion came out of the stock market in the past week alone. That's a lot of money coming out of the stock market. That's mostly mom and pop. like freaking out and calling, and some institutions, lowering their positions, margin sellouts. But a lot of the times, it's basically a lot of mom and pops like, oh my God, this market, now I'm really scared, and they keep on moving more money into the money market funds from their mutual funds, because $1.8 billion is not, it's big mutual fund money. And whose money is it? It's the general public, right? So bottom line is that it can be used as a contrarian buy signal short term, because so much money has flown out of there. In the meantime, if you look at the 10-year government bond yield, that didn't really collapse on Friday. Interesting, huh? It's still stuck around 2.19. What does that tell you? That money did not rush into the safe havens. Rushed into my Bitcoin, that's for sure. Safe havens of U.S. Treasury, which is the first indicator that something really bad is happening. All right? So the safe haven buying shown on the TNX or 10-year government bond, the yields did not spike. Remember, the price is inversely correlated with the yield. So the price, so the 10-year yield was flat. Generally, it would, the 10-year yield would generally drop as money moves into the government bond treasuries, because then the prices would rise, right? Just like anything else, money going into a stock or whatever, prices rise and the yields would fall. So if we break 2% on the U.S. government bond, that means that a lot of big time money is moving into the treasury market. That's obviously going to affect the markets in a negative way. You understand that part, K-Bot? This is very important for all traders to keep in mind.
Yes.
You understand that, right? Because if the yield drops below 2%, for example, that means a lot of money moved into the government treasury market, and that's known as a safe haven, like safe haven buying. They just park it there. So anyway, so this is, the NYMO is very bullish. I don't know. So what we have done today is we have looked at all different scenarios, not just levels and stuff, but different indicators which are showing somewhat mixed signals. How about that? The candles are not pretty. No question about it. NYMO, very bullish. Like what's going on here, This is great. All of these. The swing 533 that we looked at is kind of mixed. But that is today's market. So any quick questions that I can answer? We can certainly look at a stock or two. Oh, the VIX part. I don't have the quad on this particular computer, but my VIX levels, I think I last posted the VIX at, hold on. Well, it's all on my Twitter feed. Where was the last one? Hold on. VIX I purely track on on the quad platform. It has been a fantastic blessing to have that platform, because I don't know how I would chart the VIX like this. Where is the VIX? Okay, beautiful. Remember, VIX patterns, these are derivatives, right? They move differently, but you can still identify the patterns. The big gap, remember, the yellow line is always the pivot. So the pivot's right there. And this is where we are. This, to me, to be honest with you, why I think the market still has a little, this looks like it's almost like a cup and handle, right? So busting a move up here means retesting back that 1650, 17 level. So that's one scenario. However, this also resembles, let me change the color of this thing here. This is the final chart that I'm going to walk you guys through. This also, and nowadays the VIX is every single minute right next to my split screen on one of my monitors. Okay, you have to watch this. It tells me pretty much what the market is going to do in the next 5 minutes. Seriously, right? No kidding. Because the VIX is totally correlated with the markets right now. During extreme conditions, the VIX is totally correlated with the market. So with your trading, just by looking at this, you know exactly when to take profits or go long and short. Seriously. So this pattern is also similar to this. What happened here? went below. Where do I think the VIX goes? Well, I don't know, but I'm looking at my lines. Here's your downtrend lines, and I believe the VIX hits and retests the downtrend line, which is also the previous breakout line, approximately 1280. 14.4 to 1280. How much will the market go higher? KBOT, how much do you think the Dow Jones will go higher? I've already said that. From a drop on the VIX, just to retest the downtrend line and the breakout line right here, where it's going to bounce. No question about it. Because by that time, the slow stochastics will be deep oversold. You can see the slow stochastics is heading down. And that's what I was waiting for. And I got it. Right? So I got it. That's when I just, I said, that's it. The VIX slow stow is now heading down. It happens real quick. So when the VIX falls and retests this and decides to bounce from here, how much of a drop in the market is that roughly on the Dow Jones? Okay, what? Roughly. We talked about it.
About 150 or so.
Yeah, like around 150, 200 points maybe, max. All right? Somewhere in that range. You're correct. So bottom line is, there is also an uptrend line here. So the VIX can drop to 12 too. I don't think the VIX is going back to 9. If that's the case, this market is going to 2,600 S&P or 2,550. Can happen, believe me. Trump team is working real hard with all the bad publicity and everything they got recently. They are trying real hard to divert everything and put things on track. Couple of powerful initiatives on the infrastructure tax reform side, positive thing. Bang, the market is going to take off. And then you will see this. But I don't think that's happening. But what the heck do I know? Otherwise, you get a minor bounce, which you need to short on the VIX. You can clearly see what's going on here. Moving up here will create a big double top. Candles patterns are saying the VIX is going down. And down means exactly to these levels. So please monitor the VIX, watch the lower column. This is intraday oversold, so it bounces a little bit, just the way it did. But here, this is key. Once it gets down here, it's going to kind of, it can waddle. Remember, it can be like a day. It kind of just did nothing and kept on going down. Markets kept on rallying. That was back on the 14th, right? On that big Monday open. And then all of a sudden, it like a jaws, like shark, boom, goes higher. So that, gentlemen, is the roadmap in the coming week and towards the end of the month. Any quick questions, please? No? Quick question, because I got to go. Jody?
I'm good.
All right.
Yeah,
Thank you.
Will the move in oil support the IWM this coming week?
I'm sorry, what was the question?
Will the upward, oil was up 3%.
That should certainly help. But thank you for reminding me on the IWM, because this is key. What I saw, and I posted obviously. Yes, it certainly will. But more importantly than oil, Jody, what's going to help the IWM is exactly what I said. The Trump team is not idly sitting around. They are going to basically deflect and garner very positive attention by introducing direct measures on the U.S. infrastructure side and stuff. And you know who the biggest beneficiaries are. U.S. small cap growth. Got it? So that to me, I think is a bigger catalyst than oil.
Okay.
Yes, because that's big. Now, looking at this, this is very defined. Look at that. We got a nice little, I'll say, move here. Bought the calls around 6. In the high 6s. They went to 9, and they closed at 8 and change. I left them alone. I wanted an expansion of the candle to add. Look at exactly what happened back on the 18th of May. If we do slip and burn a little bit more, here's your next level of entry, which is 1342. Critical support, 1335. I'm going to be watching this very carefully. If we do get a sharp bounce, and again here, a positive divergence. Can't get away from this. Now, this positive divergence happened when the the RUT was at 1371. Guys, I love 5-10 points on the RUT. I'm not complaining. And I'll go real aggressive. I'll buy 20, 30 contracts. I got pretty aggressive on the S&P trade, on the fast one, 6 points. Now we're very aggressive on the 11. That was sweet. So it takes away the pain of losing money when we get caught on certain downdrafts. Certainly takes the pain away, So bottom line is that this move alone, just to test the 5-day SMA, is 1376. That's 20 points. So this I like a lot. Do I think these two levels will be met? Not sure yet because of this positive divergence. If we did not have this positive divergence, I would basically say, okay, it looks like it wants to go back towards 1335, which is 1334, which is roughly 20 points. Can happen, and we can short it if it breaks this level. But I'll let you guys know. Remember, there's a big double barrel bullish engulfing reversal off the 1342 level. So that's a critical support. So I like this chart a bit. Jody mentioned the oil part, which I showed oil. All right. And I think oil is oil's like the VIX goes straight up and straight down. So the last thing we'll look at, here on the daily, we are seeing the turn of that 34 and the 50. So that's longer term bearish. Now this wants to be bullish. You need that big news on the infrastructure side and all that side, because that's what small caps benefit the most from. So this now crossover, if it continues, that means it's just all bounce place. If this turns around, we need the RUT to cross over 1400 for this particular negative crossover to be decimated. We need a sharp, powerful thrust higher, a breadth thrust, which will take us over the 150-day moving average, which is 1391. Whichever the case, as traders, we're in for the money. We're in for the 10, 15, 20 points. So this is a very clean-cut chart, and I'm in. All right, so just follow this for your trading purposes. Buy 1 or 2 contracts, whatever you do, and make the money. Intraday, scalps, anything. Remember, it moves 5-10 points fast, sometimes intraday. So you have to be watching this. Now, last chart, oil. And remember, this applies to the IWM too. So oil, where's my oil? Strange. Okay, I'll just put it here. So this is the unconstructed chart, but you can see what's going on. This is what's going on here, which is really bullish, okay? Really bullish. First of all, you got a whole bunch of multiple patterns here. You got a head and shoulder that is still very intact. Head, left shoulder, right shoulder, okay? 150 moving average right here. It looks like it wants to bust a move above that. Here is the most important signal that traders can deal with. That's why oil stocks are back in play. Look at this. This is your 3450 crossover. Guys, the 3450 crossover happened while oil was pulling back. What gives? That is big. That means the overall moving average of the 34 and 50 days is still suggesting oil is going to go higher. This is, gentlemen, you can call it a cup and handle if you want to put like a V-shaped cup. Here's your handle. Here's your big fat breakout, the 3% higher on Friday. From nowhere, right? Just like boom, just like that. Right, Jody? It just basically came from nowhere. Just started to go, right?
Yes, that's right.
Exactly. This is what happens. There was no OPEC news, no Saudis saying, oh, we're going to cut oil, the production, nothing. Just like that. Move higher, very positive. Just the way it did here. So a movement will cap it, close past 50, big media headlines, oil's over 50, blah, blah, blah. Max move 52, in my opinion. And then oil's going to, and then it's going to rinse and repeat back again. By that time, deep overbought. But this is very good. So between here to here, we got to trade on the EOGs, on the MROs and stuff like that. But if oil does break out over 52 for whatever reason, you are going to see a bloodbath on the short side. And of course, that's going to help the markets too. Thanks for bringing that up, guys. Let me sign off. At approximately 12:44 p.m., I will do a free market ACS, just kind of watered down version as I normally do Sunday evening. Feel free to attend it. Futures will be on, so we can actually see a lot of the things that we talked about here in motion, and we'll go from there. Have a great weekend, and God bless all. Hope everything's good, okay in Boston. I'm sure it is, and we shall see you guys tomorrow evening if you can.
Thank you, Frick.